All right. Well, looks like we're ready to get started. As a quick introduction, my name is Sarah, and I'm part of the venture team here at AngelList. If this is your first time joining us for a Dev Day webinar, welcome. And if you have joined us for past webinars, welcome back. It's really great to see you again. And I'm excited to welcome you all to our Spring 2025 Demo Day webinar. So today's webinar is all about walking you through how AngelList Demo Day funds work and answering some of the thoughtful questions you submitted for our spring fund leads. And before we dive in, just a couple of quick housekeeping notes. This session will be recorded and we'll share the recording with all attendees later this week. And it'll also be available on the AngelList YouTube channel. We expect the webinar to run for about 30 minutes, so you'll have a little bit of time back in your day afterward. We'll be answering several pre-submitted questions, but if anything comes to mind while we're chatting, feel free to use the Q&A feature in the Zoom to drop those in. We might not be able to get to everything, but we'll cover as much as we can. And thank you again for joining us. It's really great to see this level of interest in the Spring 2025 Demo Day funds. For those of you who are new to AngelList, we're a software company with a mission to accelerate the rate of innovation. We believe that startups and those who invest in startups are crucial to this mission. We do this by building the infrastructure to power the startup economy. We provide fund managers with the tools that they need to launch or scale their fund. This ranges from full service offerings for first-time or emerging managers to established firms looking to streamline their fund operations. Y Combinator, or YC, is one of the most recognized startup accelerators globally, and many of today's iconic companies like Airbnb, Stripe, and DoorDash, and a few others, including Coinbase, Instacart, and Twitch, all got their start through YC. YC now runs 4 batches per year, which creates more frequent opportunities for founders and investors to connect through demo days. This marks the first ever spring batch in YC's history, so it's a pretty big milestone moment as we expand into this new quarterly rhythm. So where exactly does AngelList fit in? Every quarter, in parallel with YC Demo Day, AngelList partners with esteemed YC alumni. Each are launching a fund that gives you the opportunity to invest in the spring 2025 batch of YC companies. You can choose to allocate your commitment equally across all 5 funds, and you may also choose to invest in specific funds. The fund leads will leverage their YC connections and personal experience to deploy that capital to the batch's strongest companies. Today's webinar is a chance to meet these fund leads and hear a little bit more about their investing philosophies and overall thoughts. All of our leads are successful founders, experienced investors, and YC alumni. So without further ado, I'd love to introduce our fund leads, Ben, JJ, Philip, Rami, and Yaya. Thank you so much for being here with us today. And to kick things off, I'd love to do a quick round of introductions to share with the audience a little bit about yourselves and your background. So Ben, we'll have you go first, and then we can go in alphabetical order by first name.
All right. Well, pleased to meet you. I'm Benjamin Bryant. I've been running Demo Day funds since 2017. So this is going to be my 9th Demo Day fund that I run. I was early participator in Y Combinator in 2011, and it's behind Pebble and behind specifically their $20 million crowdfunding campaign that kickstarted the Pebble smartwatch. Let's see, prior to joining the startup world, I spent 6 years as a high frequency trader at 2 hedge funds, and then early have an academic background career in computer vision, some early AI research and stuff. So see, engineering from Michigan and a master's in finance from London Business School.
JJ, do you want to go next?
Yep. Hey, everybody. I'm JJ. This is my 6th Demo Day fund now, so I've known this for a while. I started a company in the winter 15 batch called Way Up. We're the largest marketplace for students and recent grads to find jobs and companies to hire early career. Ran that for about 7.5 years. Sold it in 2021. And then when I left, the company was around 150 employees. Right after that, I went back to YC and worked there as a visiting partner, doing the job of a partner. I worked with over 100 companies, did all the admissions and interviewing, helped them raise collectively over $200 million in seed funding. all that made me super well placed to know how to invest in YC companies. It just was a totally different experience than when I had been an alumnus coming out of YC. And I think I'm a better investor, not just out of YC, but in general, from having gotten to see so many companies go through and what they're like many years later. I've been investing for about 7 years now. A lot of that time as an angel. I had early checks into Ramp, DBT, Retool, High Touch, and others. And before that, I was in a specialized program at Penn for international studies at business, then McKinsey, and then taught myself to be a fully fledged software engineer and DevOps engineer, which is what I kind of leaned into when I started the company.
Great. Philip?
This is my fourth batch doing active YC investing. I've been investing for the past 8 years. I've done 50 plus investments. Past investments include Anthropic and Perplexity. I was a summer of 2015 YC founder. I built a consumer hardware company called Nebbia. Built that for 9 years, went through all sorts of ups and downs, and sold it in 2022. Our first investor in that company was Tim Cook, who we met while doing beta testing for our product, backed by Eric Schmidt and Joe Gebbia. For the past couple of years, I've been doing early stage deep tech investing. And then about 6 months ago, I was asked to join a YC company from the summer of 2018 called Supplant as CEO. It's a food tech company that was backed by Khosla, undergrad from Penn and grad school at Cambridge.
Awesome. Rami?
My name is Rami Assad. I am a serial entrepreneur and now investing. I started and sold 3 companies, one of which obviously I took through Y Combinator in the summer of 20. Across my 3 companies, I raised over $80 million, returned over $250 million. The YC program was great for me, not only to build my network and get more distribution for my company, but also built those lifelong relationship with the managing partners that we all leverage today.
And lastly, Yaya.
Yeah, my name's Yaya. I'm a serial entrepreneur. I've done 3 startups now. My most recent, we went through Y Combinator in the winter 16 batch, raised 85 million and sold that for 1.3 billion. That was called Truebill. Now it's called Rocket Money. It's the biggest personal finance app. I've also been angel investing in startups for about 10 years now. So as far as YC goes, I've invested probably in around 50 YC companies and more than that overall. During that time, learned a ton and been lucky enough to get in early with some with a few unicorns and some others that have done really well.
Great. Well, thank you everyone for sharing your introductions. So now I'd love to dive into some of the pre-submitted questions we received ahead of time. On to our first question. Every batch brings something a little different, new themes, energy, and founder dynamics. So we love to kick off our Q&A to learn a little bit more about how you're thinking about this one in particular. Are there any trends or thematic focus areas you're leaning more heavily on for the spring batch? And maybe we can get started with Yaya.
Sure. So, over the last few batches, the big theme has been enterprise and B2B AI. And there's been a ton of overlap and redundancy. So we've seen a lot of companies doing things like either medical billing or AI for medical back office. We've seen like a lot of legal AI companies, so AI paralegals or AI for some other legal function. I think what we're starting to see more of now that I'm really excited about is consumer AI or AI that's kind of available for like everyday people to help with their everyday lives. There's already a few companies in this batch that have either announced or launched doing like B2C consumer AI, and that's something that I really want to lean in on this batch. I think it's really exciting.
We can go with JJ next.
Sure. I think it's true that each batch does have some trends, but I would say personally, I don't really invest thematically at all. It always just comes back down to the founders for me. And I think I say it's like every webinar, but a lot of the best YC companies, like some that are common themes when you talk to founders going through YC, like Brex and Retool, which I'm an investor in, they only pivoted to their idea well after demo day. So AI has obviously been a big theme. I think it's such a theme to the point that I stopped saying it anymore because it's like saying mobile is the theme. It's just part of everything. as I've been looking through this batch, one thing that's been a little new that's been interesting, voice AI has been prevalent the past few. Now I'm starting to see more companies doing, I don't really know exactly what to call it, basically using LLMs to parse extremely complex technical documents for specific industries like aerospace, or hardware. But I think all of this is just a reflection of what is becoming possible as LLMs get better, and not necessarily a reflection of what's actually going to be a good company or a good business or where things are headed. I really just, for YC companies, come back down to the founders.
Philip, do you want to go next?
Yeah, to build on what JJ was saying, for me, it's always about the founder. If there were one focus or one area, YC has called this the year of agents. I think the next step is not just at the application level, but how our agents interact with each other, the so-called agent economy. Some sort of vertical.
Ben, do you want to go next?
All right, sure. Yeah, I mean, to echo stuff like, we look to YC to kind of pull in what is the next wave of technology that is going to, move us forward in the next decade and so forth. And so for today, this is really AI-powered workflows. Agents are is here. And so, we're not, from our perspective, we're not, I want to say, specific on any version. We're intentionally very broad in what we say. So, what we look for is what we're going to look there is going to represent largely what we see in AI. And so, inside the agentic workflows and so forth, we're looking to, there's been a more prevalent of, let's say, industrial regulated industries. There's kind of like, I'd say, an uptick in companies focusing on that as their vertical. You've got a lot of what I'd say, call AI infrastructure stuff, which has changed over the years because, what problems we had last batch have now kind of been solved, and there's a new problem that's coming up. So if I was going to highlight a lot, I mean, like one of kind of some of the interesting things. So MPC, which is called Model Context Protocol, it's basically how does an agent know what it should be working on, and also what are the actions that an agent can do. There's a couple of interesting companies that are developing infrastructure for, I want to say developers on that end, infrastructure to be able to do that at enterprises. Learning and correction with inside the AI space, that's another interesting thing. Like if you're going to have these agents autonomously working out in the world, all right, they're starting to do so much stuff that we can't reliably control or even monitor them. So you need to design a system where a control structure where they can kind of revert back or figure out as they go what the correct outcome is that you want. It's beyond guardrails. It's about kind of self-correction. And then there's also a fairly prevalent theme in this batch, is going to say, of robotics, particularly like, say, embodied AI. So, the idea of being able to have a robot, whether it's inside a factory or so forth, autonomously figure out what it is that it needs to do. So that could be for, path generation for a robotics arm with inside a assembly plant, down to, tree reasoning or kind of enabling, want to say, high mix applications. And then, there's always every batch, a couple, deep tech, biotech companies that are doing something, very interesting in the space. So, or in space in this particular case, or, want to say, nano manufacturing. I think there's a company in this batch and so forth. So things that are, true moonshot ventures out there that, YC as an institution enables these brilliant individuals to get the financing that they need to be able to make that thing, happen and transpire. So, very broad offering with, a large percentage of it going to be AI, because that's where the leverage and the value add is today.
And Rami?
As Ben alluded to, YC does a really great job of changing up what they're looking for every batch. In fact, they put out a request for startups each batch that calls for the types of companies that they're looking for. And what I found is they're in those themes that they put out, they tend to be a little bit crowded. So noticing those themes, I try to cherry pick a handful across those themes, but not over index there. What's really interesting is that they put out their next request for startups for the next batch halfway through the current batch, which is a little forward leaning on where their head is going. And I try to see if I can find any current batch companies that can front run that theme for that they're looking at for the next batch. Outside of that, I try to avoid companies that are going too generic. Sam Altman, I think, has a quote out there that talks about that startups should expect that AI models will continue to get orders of magnitude better. And the tidal wave of money that's being spent on generic models is going to sweep over any startup that kind of stands in their way. So anybody that's doing something too generic will get swept up in this flood of money that's being spent as an arms race in LLMs. So what I look for is hyper bespoke software that are solving very niche problems that are going to either provide a different UX, a very purpose-built solution for a smaller audience, but they can capture a high amount of value from that large audience. I think that's going to provide more longevity to the startups that do that.
Awesome. Well, that's super helpful. Now, sort of transitioning into sort of how you evaluate founders. I know a few of you touched on this a little bit, but I'd love to sort of ask, how do you evaluate early stage teams, especially co-founder dynamics and decision making when traction is still limited? And maybe for this one, we can start with JJ.
Sure. This is one where it's hard. I'm lucky that I had to do this hundreds of times at YC with only 10 minutes. So 30 minutes feels a bit luxurious now. But there's a shocking amount that you can tell about a founder's grittiness, seriousness, and judgment just from even whether it's 10 minutes or 30 minutes. A lot of that boils down to how well they know their space, their numbers, how deeply they've thought about how they'll grow. In some ways, well, obviously more traction is nice because it de-risks things a bit. There's no amount of time you're going to spend in YC that used to be 3 months and now is a bit less, that you're going to have such amazing traction that it's totally de-risked. So in some ways, this is better because if you have a founder with little traction who is talking extremely intelligently and thoughtfully and pushing back on questions in the right way, and they're doing so with confidence and knowledge that you can then go research later and make sure it checks out, that can be much better in understanding who is just good at diving deep into something and pulling something out. Because again, many companies pivot. Many of the best companies, even with great founders, find an idea isn't going to work and pivot. And to what we were talking about in the age of AI, that's kind of the most important thing. Even companies like Windsurf, which just reportedly is selling to OpenAI for $3 billion, they pivoted a few times. And their most recent pivot to Windsurf was only a year ago. So you want founders like that. As far as co-founder dynamics, they're usually not all on the call, but there's a lot you can look for in their background, which is research I do ahead of time. Like how long they've known each other, how they met, if it's an unusual space or something very specific like hardware or certain types of AI infrastructure, what domain expertise do they have and how is that shared among the founders? And it's something I'm not afraid to dig into and ask pretty pointed questions on a call. Founders are usually surprised by that and they'll answer pretty honestly about how close their relationship is.
Got it. Great. Why don't we ask Rami next?
All right. So I think, the old adage, it takes one to know one. All of us being founders, I think gives us a really great edge in understanding the mindset of what makes a great founder. For me, I won't touch on some of the things that JJ already said, but I'll add two that I think are really important. One is their ability to storytell. Can they break down their problem and their solution into a digestible story? Help me understand what they're doing, why they're doing it very quickly. That's going to be critical now, but also in the future for fundraising, for customer acquisition, for employee acquisition. Your ability to tell the narrative and rally people behind it is critical, I think. The other is how they go about developing a problem, or developing a product, right? Their product development methodology. How did they come up with, discover the problem, how customer centric and how they're going about solving it, how fast do they iterate on customer feedback? All of that is great and a great indicator to the velocity that they're going to be able to have in terms of cycles of try, rinse, and repeat. And I think the ones that do that the quickest are going to be the ones that can adapt best in this day where you don't engineering velocity doesn't matter because of AI, and sales velocity won't matter as much because of AI. Everything's going to be commoditized. Your ability to react and iterate is going to be probably one of the most important things.
Great. Yeah, do you want to go next?
Sure. So JJ touched on quite a few of these. Obviously, you really want to get a sense for how these people know each other. How long have they known each other? Have they worked together? Has it been a purely like friendship-based relationship or something else? Additionally, he also touched on domain knowledge, like how well do they know the specific problem they're trying to tackle, and do they just know it from personal experience, or do they have like specific experience working in previous companies that have tackled this? Beyond that, one of the big things that I really look for is discipline, right? Like a big part of a startup sort of making it past that super early stage to an established phase is prioritizing and being willing to make compromises on in terms of what you focus on, such that you distill down to really what will matter and what will move the needle. So I love understanding like, how did you spend the last 3 months? What were your priorities for the last 3 months? What are the things that you would have wanted to do if you had more resources? And likewise, looking forward, what is it that you plan to do in the next 3, 6, 12 months, and try to get a sense for, are they really being disciplined in accurately controlling how much they go after and how much they try to take on. I think that's a super strong signal.
Great. Philip, do you want to go next?
Sure. I mean, building on a lot of themes that have already been mentioned, but to an extent, it's impossible to predict with certainty who the outliers will be, and we're all trying to invest in the handful of outliers that are going to come out of the batch. Yeah, there are certain patterns that increase the probability of success amongst co-founders, or said another way, are more highly correlated with successful teams. Past work experience together, do they share a work culture and language and work ethic? It's great if they were friends from college or roommates, which we often see, but that's very different from understanding how someone works, how they approach a problem, how deep they're willing to go. Secondly, founder market fit. I think this is ever more important, with the speed at which AI applications and companies are moving. Really understanding what are the pain points and the issues that customers are facing intuitively is a major leg up. Empathy with customers. I think humility, which is often a sign of adaptability, effectively in these, this 2.5 month sprint of the batch, founders are trying to figure out what customers actually want. And if there's a sign of humility, it's often a sign that they're willing to really understand what the customer wants, not just what they want to build. I like what JJ said earlier. I often try to ask uncomfortable questions and see how they respond. Will they get thrown off by the way that a customer reacts to them? Or are they quick on their feet, and do they, hold their perspective, but with grace? Are they listening acutely to understand what the questions and feedback are that they're getting? There's always exceptions to these rules, but those are the frameworks I try to work with.
And lastly, Ben, do you want to go next?
So yeah, I would just make the note. I think we've just described like 98 or 99% of the batch of YC founders. My experience has been, and I've invested in over 400 YC startups. So 2.5x that in terms of founders or so forth. The YC partners, the YC brand does an incredibly good job at attracting exceptional people. There is this kind of idea of founder market fit or so forth. A biotech company is going to require a certain degree of academic research and focus in there. And then you move to, some more mainstream companies or stuff. And there are things that, you look and say, this makes sense. But at the root of it, you are backing a YC founder because this is someone who's willing to dedicate 10 plus years of their life to success, whatever it is. And so if I look historically back at, from like my Summer 17 fund, it was 6.5 years before the first founder threw in the towel. And they worked every single day, 24/7, driving that company business. And it really came to the point, like that particular fund, it wasn't working in that company. But that's one out of, a large percentage of companies around there. I look at co-founder dynamics. Like you see, sure, there's co-founders that go and split off, but almost uniformly there is some person that is riding this horse the way that has that vision. And if founders split off and so forth, like particularly if it happens early, that's very good because that's someone saying, look, this is what we need to be the most efficient we are going forward. And so, in literally one instance out of those foreign companies has it led to the dissolution of the company or kind of something, existential about the business, and even that case, it happened early and we got 70% of the capital return. So, it is a rounding error in terms of our, overall funds, so I really think one needs to look at it in perspective. The reason you are, let's say, coming to AngelList to the YC demo days is because the individuals sitting up front here are the people that actually have access to these companies and are able to, broker the relationships. Just, as Rami said, it takes one to know one. Well, it's also on the reciprocal side, like founders want to invest in people that understand them. And so we are the individuals that are able to get allocation within inside these deals. Not all deals are going to move rapidly, but a percentage of them are going to move exceptionally rapidly. And, other investors, larger funds or so forth, just cannot get the consistent allocation that Demo Day, alumni have been able to do. So, again, my perspective is, and I've heard this from several, YC partners, you ask them who's the great people in the batch, they always say all of them. It's very rare you come across someone that just doesn't gel and doesn't do right. And so, I don't tend to dig in too deeply into any particular one because historically it just hasn't mattered into it. It's much more, having, I want to say, access to this particular track record of individuals that is just going to work because they're driven by a true passion.
Great. Well, thank you everyone for sharing your insights there. Now let's switch gears and talk a little bit more about the structure of your funds and how you each approach things differently. So for LPs who are thinking about where to allocate, this next question might help shed some light. So what are some of the key differentiators between your funds? For LPs who are choosing between leads or choosing to invest across all, how would you describe your unique lens or thesis? Maybe for this one, we can get started with Rami.
Sure. I think some of us have a broader lens, and I personally have a little bit narrower of a lens of selecting. I try to index the top quartile of YC companies and do so with about 10% of the batch. 10 to 15% of the batch. So if there's a 200-person batch, I try to select about 20 of the companies, or 200 company batch, I try to select about 20 of the companies, assuming that, if I think that they are in the top quartile. I do, rely on feedback from the managing directors. I try to stay away from themes that I don't understand altogether. So bio, for example, I will stay away from. I just have no expertise there, and I just can't call balls and strikes fairly in that regard. But outside of that, I think I try to be. I don't go as specific as only my subject matter expertise in categories, but stuff that I can pattern match across.
And Ben, do you want to go next?
Cool. So yeah, we have a fundamentally kind of say broad viewpoint. So we build broad, diversified portfolios. Historically, we've done around about 50 companies each batch. It's gotten up to about 83 in some of the larger batches. And the goal and focus is on portfolio construction as much as is picking winners. So, we diversify geographically, we diversify across business model sector, very purposely do go deep tech, biotech, and so forth. And our portfolios tend to, represent the overall mix of the YC, portfolio. So we're going to be an AI workflow heavy fund this time around because that is what YC is, and the reason we do that is really just kind of a very kind of quantitative perspective. Is if you look holistically at this, its returns are driven by the power law in this particular asset class. And so, the broader we go, the the more we put in there, the higher our probability is of netting some of the large whales within inside this current sampling space. And so that actually ends up elevating the overall expected value. Much more, again, kind of alluding back to what I said last question on there is, our focus is being able to move fast to make quick decisions, and also having a risk model that allows us to, allocate some percentage of our capital to the companies that may not, in fact, actually have that much traction, or other things that, perceive them being riskier because, while they may not work out, they may do other things there. Like the magic of if it does work out in that particular direction, is really where you're going to see, the big wins come for it. And my experience has been, when I look back retrospectively at, where have we missed companies in particular batch? Invariably it's because we didn't even know the company existed in that particular batch because they're working on something completely different. So, the way my viewpoint is really, this is a, game of large numbers. There is some degree of insight and I want to say information value that we add. Historically, I've looked back, we do perform about 15% better than average in terms of picking, I want to say, high value companies out of the batch. But really applying kind of just core tenets of portfolio theory to this very specific asset class.
Awesome. Philip?
Sure. How do we differentiate strength in numbers? I co-invest with two partners. We have different backgrounds, and we aim to invest in the top 15, 20% of the batch. Between us, we're deeply integrated into the YC community. We have different backgrounds and expertise that gives us broad coverage across different companies. Each batch, we look at the companies, we make our own sort of division of themes and trying to get coverage across those themes. Brian was a YC Winter 15 founder. He's done 3 companies. He's currently building another one, strong operational knowledge. Mike is also a builder, former product lead at Airbnb, and was a growth investor at General Atlantic. But as I said earlier, we really focus on the founder. Is their market fit? And co-founder dynamics, how have they worked together before? And then more broadly, are they playing in a really big space?
Awesome. Well, why don't we do Yaya and then JJ to close us off?
Yeah. So from Rami and the way Rami and Ben are approaching this, some of us are approaching this more as an index fund to capture a bigger slice of the batch and index across the top, say 50% or something. And then some of us are taking a more targeted approach. I generally aim to invest in like 20% of startups, so the top 20 or 25%. It's definitely more targeted. And then within there, I think I'm pretty comfortable supersizing bets on individual companies if either the founders or the traction just blows me away. Whereas I think others sort of keep their check size standard across the batch. So it really depends, like, are you looking for an index fund, or are you looking for more like traditional targeted VC fund that's going to make a smaller number of bets and hopefully get outsized return on those bets?
Cool. Yeah, I would say similarly, the more I've been doing this, the more I've found myself wanting to be a bit more concentrated in the winners. YC in general is great, as Ben said, but there also is a power law here like everywhere else. And my goal is to pick well early and without sharing too much more detail with as unfair an information advantage as possible. So I tend to concentrate into the companies who I expect to perform in the top 10 to 15% of the batch, which I'll note is different than are currently in the top 10 to 15% of the batch. It's those who will eventually be in the long run. That ends up meaning I'm in both many of the hottest deals where sometimes I end up as only one of a couple investors. I also get information about who are the best underrated founders and get into those at a great price, which has done well historically as well. Thematically, I'm totally generalist. My first batch working at YC, I was in the biotech and hard tech batch, so I'm not afraid of those. And I also have deep technical software and infra experience, so I often validate those products personally.
Great. Well, thank you all for sharing your thoughts there. On to our next question. So there's obviously been a lot of macroeconomic uncertainty lately, from rate changes to broader market shifts. How does that environment affect how you're thinking about early stage investing right now? Maybe for this question, Ben, do you want to start us off?
Sure. I think, let's see, it's important to kind of understand that. I mean, if you look at early stage investing as a whole asset class, like it is largely uncorrelated with public markets. And I think, again, I come from a, core tenet of portfolio theory, but those are the type of things that I look to add into my portfolio against, 40-80 bond split or whatever it may be. I mean, there, and, you need to think about, well, what actually transpires within, the degree of economic certainty when you're a large public company, essentially the battleships of, industry and so forth. Like you cannot be agile, you cannot adapt. Like you want predictability, and so erratic policy shifts really have your impact on your ability to, plan and have tangible effects on when I say, your midterm capital flows that you cannot change. The polar opposite when you come to early stage investors, these are companies that, I mean, good or bad times are constantly reiterating and reiterating on what they do. And you look at maybe, what are the upsides and downsides in here? Well, let's say the economy does go negative in the next few years or so forth. Like, first of all, we have companies that, by default, if they never even raised company money at YC, have, about 2.5 years of runway, and they're raising 4 to 8, sometimes 12x that amount of capital coming in here. So, these are businesses that have a very long time to figure something out. And, if were things to go south, which I think we're a lot more optimistic today than we were last week, coming on here, these are, what's going to happen? You're going to get interest rates are going to drop to stimulate the economy. Well, venture performs incredibly well. They love low interest rates. I mean, we've had some of our biggest exits and markups coming in periods of times of low interest rates, and vice versa. Where is big industry going to go for customers and stimulation when they need to cut costs? Well, they're going to go for the cheap AI solutions, solutions that these startups are, ability to deliver and attach. So, in some sort of degree, if you actually think through it, there's a lot of kind of, want to say counterbalance that comes from putting capital in early stage businesses. And likewise, when things are going good, you have businesses that, again, are constantly iterating and seeking how to get that, exceptionally high year and year cash, growth out of it. And looking back at, I mean, last batch, I think on average, they had the highest week on week growth of any batch in history, which was, I think on average over 10% week on week. Back when I think most of us went through that time period, like that was, just unheard of. I mean, that was what the Airbnbs of the world seek to do, but, very few people were able to achieve it. But now, because of the transformative nature of these AI systems, we are just able to move so much quicker with such higher leverage and deliver so much more value at the early stage that, I mean, really, regardless of the economic conditions, you've got to appreciate that we are in the midst of, one of the most transformative waves of knowledge work, in this existence. And so, you want economic participation with inside that stuff. You've got to go with the people that are delivering the value there.
Great. And Yaya?
Yeah. I think firstly, macro trends, they change over time, and it's really difficult to look at to anticipate where the trends are going to be over the time horizon that it's going to take these companies to reach maturity. Beyond that, like Ben said, we are in the middle of a huge wave, regardless of momentary ups and downs in the economy. So I think just as a rule of thumb, if you're looking at companies and you can identify that these companies are going after an enormously large target market with incumbents that are not going to be able to move as quickly as a startup is, and they're not going to be able to leverage AI as quickly as a startup is, then I mean you're in a pretty good place in terms of being able to identify companies that are going to deliver value and then be able to capitalize on that value.
How about we do JJ, Rami, and then Philip?
Sure. I think and this is maybe no 3 or 4 badges in a row I've said this, I think it is better than ever, and I keep being shocked at how much better than ever it keeps being, which like it almost feels ridiculous. But like AI, count me as someone who in the earliest days was a little bit of a skeptic, but also as a daily user myself, not just ChatGPT, but of the programming tools. Everything is so much better in terms of how far companies can get with less money. Well, also there's more capital available to them, which is good for us, because the number one thing that makes a startup succeed is being around long enough to have something good to happen to them. So even though they're raising more money and sometimes at higher caps, it gives them so much more time and so much more runway. I mean, I have companies who have like 7 or 8 years of runway to eventually have that great thing happen to them and figure it out. It's, when I think about even, my own personal investing, it's like, well, the first best time was like a few batches ago, but the second best time is now. And I really, every day, I just continue to feel like generational companies are being built, and it's the highest concentration of that I've ever seen. It honestly, it just makes me excited to be around it. So it's like everyone else said, the macro kind of doesn't matter. We're talking very long time horizons, and it's not like people stopped buying iPhones because like there was a bit of market whiplash. You need the iPhone. You're going to need AI and all of these tools the same way.
I think Ben talked a good bit about the major technology shift, right? I think AI is bigger than the internet and mobile as a major technology shift. But the other major macro trend that's happening right now is where we are in kind of, let's say, a hype cycle. The boom busts of the macroeconomic the public markets tends to go on a 5 to 10 year cycle. And what we've seen historically is coming out of a bust, we have the best cohort of venture companies that come out of that. That's typically because, one, if you overfund an early stage company, it's less likely to succeed. They get too distracted, they don't focus on the right things. So you don't want to overfund them. But at the later stages, having access to capital allows them to continue to accelerate faster and have escape velocity that blows away the incumbents, blows away the public companies. And so if you can time your investments in venture to invest around where there's constricted capital, and as capital loosens up and those companies mature, you're going to see the best performance. And I think this is kind of the area that we are now. We have heightened interest rates. We've seen flat venture capital investment as an asset class, much lower than the 2021 period where interest rates were at zero levels. And I think right now we're going into a loosening period, which will mean more access to capital over the next few years, which will help accelerate the companies that we invest in now.
It's just about all been said. Ben started us off very well. That's why he's a sage. These companies are going to take 5 years to build. They will weather these storms. We all know the wisdom of the best companies are often built in the most uncertain times. The Ubers, Airbnb, Stripes of the world built during the great financial crisis. The one thing that I think does change is the mood around abundance for early stage companies. Founders should always be focused on growing revenue and understanding their levers of profitability, which aren't the same in every company, in every industry. I think there seems to be a greater focus amongst early stage founders on getting sticky revenue growth, and that's a really good sign. If I ever sense that a founder doesn't keenly understand this or believe this, it's an immediate red flag and a pass. Yeah.
Cool. All right, and now we can't avoid the topic that's everywhere, AI. So we're seeing a lot of AI companies pop up in pretty much every category, from infrastructure to consumer to dev tools. So we're curious how you're thinking about evaluating those startups. So with so many AI startups launching right now, how exactly do you distinguish the ones with long-term potential from those that might not have durable advantages? Right. Maybe Philip, do you want to start with this one?
Sure. I think it's what I said earlier about our team, strength in numbers, background as operators. We have sort of broad coverage, understand different business models, different industries. and I'm not sure if this got cut off when I was sort of giving my introduction, but um, does the application, if they're building an application, um, does it have proprietary data, feedback loops? Is there a vertical expertise or integration? What does orchestration and UX and taste look like amongst the founders and how they think about product? And are there some degree of network effects? I think all of those help fit into Sam's quote about what happens when foundation models get 10x better. Are you going to be lifted by that or not? If there are these sticky or distinctive aspects where the product is getting better as a function of that expertise, then there's a much better chance to ride that.
Great. Maybe we'll do JJ and then Rami.
Sure. I think an easy answer that it's a cliche for a reason is the founders. Ultimately, it's again how are they going to build their company more than like what does any particular thing look like today. One thing I think that has shifted a bit, speed was always important, but I now more than ever, especially if you're in a more kind of software AI space, is I look for founders who are just addicted to speed, because everybody is accelerated now. So the thing that will build a lasting advantage is being 6 to 12 months ahead of everybody else for a very long time. And you can see that, I mean, even examples like Cursor, which for a long time didn't work so well, they were just ahead of it. When the models caught up, it's still not particularly defensible to be a code editor, even an AI-enabled one. Nonetheless, they have continued to speed ahead and ship. And they're ahead not only of the main model providers, but of even any competitor who's come in. And as they continue that way forever, they'll stay very, very big and are already extremely well capitalized. So look for more of that. I also just kind of assume OpenAI is going to do everything, even if they won't. So when I'm talking to founders, if the answer is just, well, they won't, that's not good. There should be some reason that they're going to stick around, whether it's an industry expertise and connections, some unique insight, or even if it's something like what Cursor is doing. But everything else is pretty traditional. AI is not, as much as I'm so excited about it, it's an accelerator. It doesn't literally do the company for you any more than AWS did.
I think I mentioned before the concept of making sure that the company is building something bespoke or very niche. Another thing that echoes what JJ said is not just their overall velocity and development, but their customer acquisition motion. As we watched ChatGPT and OpenAI over the past 3 years, that first mover advantage and the speed in which they were able to capture the market allowed them to ride the wave when other models became less expensive than them, became even better at them in benchmarks. They maintained the users and the mind share of the population, right? And so your ability to go and land grab quickly, especially in these like few weeks in YC, watching how they go about doing that, how they go about acquiring customers is really important. And the last thing that I think is unique in this current point in time is how they wrap UX and UI around AI. For a while, AI was literally just a chat interface, right? And then Manus came out and really, for example, changed how agentic AI looks, right? And it gave us a new paradigm, and that gave them a competitive advantage for a time being to change how agents look and interact. And I think we're still in the very, very early days of seeing how do users want to interact from a UI UX standpoint with the different AI functions. And if they can bring some unique creativity there, I think they'll have a first mover advantage.
And then maybe we'll do Ben and then Yaya.
Cool. My experience has been, from the outset, a company, seldom is able to kind of architect a plan they start out with, and where they end up remotely resembles that. Even if they stay in the same vertical and generally see me. You look at historically with companies, it's always you find something that levels you up, then you kind of plateau for a while and you have to find that again and again and again. And the companies that are successful are constantly seeking and finding those scalable channels, verticals of growth. Um, so we have the AI accelerant that allows companies to do this very, very quickly and move up and so forth, but they're going to plateau. There's going to be, I want to say, competition that comes out there, but along the way, you learn insights and things about your business and so forth that provide you kind of the ability to either get to a new level or find kind of a new adjacent market. And so when I look at, YC companies, just the mindset of a YC founder, kind of the culture of YC, is individuals that are just relentlessly trying to innovate on what it is that they do. So, to me, I mean, very broadly, not to be facetious about it, but, I back YC companies because these are the individuals that are going to be able to adapt, are going to develop and discover the new ecosystems that transpire from all of the activity that happens inside this, AI shift. And along the way, you find out infrastructure layers. I mean, just moving the immense amount of data around in these systems, becomes challenging. And someone specializes just that. And it's, now they're actually a supplier to the Anthropics, the Open AIs, the other stuff. And so they are having that piece that they, ride with wave. And then, I mean, conversely, I really love looking at businesses that are looking so far ahead that are just, pure experiments, moonshot things today. Can I completely revamp an entire insurance carrier to be entirely operated by AI? Very lofty goals. Well, if you're able to allocate a percentage of those ones, like those are the people that kind of discover, very unique opportunities, and you have everything kind of in a way. So, it's not so much just trying to quote the Wayne Gretzky quote of skating where the puck is going. You've got to realize there's pucks coming every which way, and you want the founders that come along that can say, I'm chasing this, but now I see that one over there. I'm going to go there because it's bigger, it's better, it's going to go farther. And I really think, when you buy into YC, that's what you're getting is people that have that mentality.
Yeah, I
And
think these guys have all given great answers. I'll just add a little bit. I think there's two sort of challenges that present themselves today that were not there 10 years ago. And one is just upfront evaluating, what is it that the team has actually built, right? So 5 years ago, if a company had a killer demo, that was in itself pretty outstanding. Whereas today, you really have to suss out, okay, like how much have they actually built versus how much of this is just a thin layer? Is this a thin layer on top of an LLM that is easily replicable? And then from there, personally, I really look for a defensible moat. Like JJ said, I kind of assume that ChatGPT is going to do everything. So with regards to what the company is tackling, I look for like, okay, well, this company build a unique data moat that others aren't able to copy? Or are there network effects that will give them sort of a defensible position 1, 2, and 5 years from now? Or otherwise, is it even going after a super regulated space that, a large LLM just probably isn't going to want to touch? Or are they doing something that is both highly specialized, but also within that specialization has a huge target market that if they're successful at, they'll be able to capture a significant piece of?
yeah. Well, thank you all. We're coming up on time, so we'll do one quick lightning round of a submitted question. So that question is, what is the expected frequency of LP updates that will be distributed? And yeah, do you want to jump in?
Yeah. This is something I'm definitely trying to be better at. So I would say to expect certainly an update at the end of the batch, just saying what we've done, what we're excited about, and then from there, probably about every 6 months.
And then maybe Ben, JJ.
Well, yeah. So we about a month out of demo day, we put together a relatively large update that encompasses the list and details on all of the companies that we have invested in, as well as kind of some commentary and so forth on the batch. From there on out, we do want to say qualitative updates around about an annual cadence on the fund. And then we started doing kind of a summarized quantitative update. So something to kind of show revenue growth and so forth, because what we've seen over time is valuations, as you typically track, companies are raising less frequently, sometimes not at all, and so forth. So our kind of main quantitative metric has kind of sort of trailed off and become stale. So, we report aggregate revenue, aggregate, want to say, runway or so forth. So kind of, a growth and a risk metric and a few other things of kind of what percentages have you seen of the companies move from Series A through to Series B and so forth, to kind of give you a snapshot on a regular basis of just how is growth and how is the health of the portfolio doing over time. So we're pushing those out now about every half year and hopefully automating that on a quarterly basis. So.
Yeah, I think I do the same pretty much as everybody else. Most important one is the big LP update at the end of the batch, talking about who we invested in, why I'm excited about it, and then same updates everybody else. One thing I've found over the past few funds from LPs is there are quite a few people who prefer not getting a bunch of emails and would rather, you'll see it's on a delay, but you'll see some updates on the fund over time as companies have additional financing rounds and get marked up or similar. And sometimes people have questions about those, and I answer those. I think it's still evolving. Like, do people want a bunch of messages every 6 to 12 months, or do they prefer individual messages, or both? And I try to cater to individual preferences there.
And then Philip and Rami.
Yeah, largely the same. Key update at the end of the batch. Who did we invest in and why? And then twice per year on sort of key company metrics.
And similarly, one big update at the end of the batch includes, a breakdown of what every company does, why we invested, et cetera, some key commentary on the batch. And right now I'm in the process of trying to take the yearly follow-up updates on each company and their progress, their movement from product market, finding product market fit to revenue market fit to growth, kind of the stage of the company, et cetera. I'm trying to take that down from annual to biannual right now, and with the hope of maybe by the end of this year getting it even a quarterly to if it's doable. But I try to put more depth into each update, kind of summarizing what the companies are doing, how they're going, strengths and weaknesses, et cetera. So it's a labor-intensive process.
Awesome. Well, thank you, everyone. That is all the time we have for today. Again, huge thank you to Ben, JJ, Philip, Rami, and Yaya for joining us and for the thoughtful discussion. You can find additional information about each of these offerings on the fund pages, documents, and on our Demo Day website, which we'll drop in the chat. And as a reminder, the minimum to invest per fund is $5,000 with an expected closing date of June 4th for all funds. Investments will be accepted until the close date or until funds reach capacity. We'll also follow up by email with a link to the recording of today's webinar. And of course, if you have questions that we didn't get to today or want to dive deeper, feel free to reach us at demoday@angellist.com and we'll be happy to help. So thank you everyone for spending time with us today, and we hope you enjoy the rest of your day.